Welcome to a deep dive into the operational heart of nearly every successful organization. Today, we're unpacking the continuous decision-making framework that provides the how for management success. We call it the management accounting engine.
That's right. And the material we have really outlines the definitive summary of this engine, the Plan, Control, Evaluate Cycle, or PCE.
PCE.
Our goal here is to, synthesize how this closed loop turns detailed, proprietary internal data into a powerful competitive tool. We want to help you understand the internal playbook companies use not just to function, but to actually run and win the race.
That's a perfect mission. So before we can fire up the engine itself, we have to understand the specific type of fuel it runs on, because this is where the critical distinction lies.
It really is.
We are so used to seeing, one side of the accounting coin, the public side.
That's exactly where we have to start understanding this duality of information needs. An organization's total accounting system, it must fulfill two equally vital but profoundly separate functions.
And they need different information to do their jobs.
Fundamentally different information.
Okay, so we know that financial accounting handles the external reporting. It's what everyone sees.
Exactly. That is the function dedicated to securing capital. Its data is, it's summary, it's standardized by external rules like GAAP, and it is purely historical.
Looking backwards.
Always looking backwards. Its purpose is external, fulfilling stewardship and reporting obligations to investors, creditors, regulators. It is, the necessary, unbiased scorecard.
And using that race analogy, this is the final official time posted on the board for the spectators and judges. It determines your ranking, your eligibility for future funding.
Whether people trust you enough to sponsor you next year,
Yeah,
it's all external validation.
precisely. But here is the massive gap most people miss. If all you have is that external scorecard, you have zero ability to actively improve your performance during the race.
And that brings us to the internal need. Competing effectively, that requires management accounting.
And this is where the proprietary data, the secret intelligence, comes in.
Absolutely. The nature of this data is detailed, highly specific to the internal operations, and crucially, it's forward-looking. Its sole purpose is internal, to fuel that plan, control, evaluate cycle.
It's the cockpit information.
They're the cockpit information that managers use to make decisions, run better, and innovate.
That makes the distinction crystal clear. The external system reports the score. The internal system designs the plays. But why is this management accounting data a competitive tool that competitors can't just copy?
Because it embeds unique process efficiencies. I mean, your rival can see your financial statement, sure, but they cannot see the proprietary cost structure you developed over decades.
Or the specific variance threshold you use to manage waste.
Exactly. Or the unique formula you use to calculate return on investment across your disparate divisions. It's just too firm specific.
That's a key nugget. The source mentions DuPont, which famously pioneered the use of ROI internally. Why was that so revolutionary?
Well, you have to remember, in the early 20th century, DuPont was diversifying rapidly. Management needed a common metric to evaluate these massive, wildly different business units.
From chemicals to film, right?
Right. How do you decide where to allocate scarce capital? By making ROI a mandatory internal metric, they created an objective, comparable framework that linked operational efficiency directly to shareholder value. That's management accounting providing strategic direction, not just historical reporting.
So the takeaway for you, the learner, is this. A business that relies only on financial accounting knows the final score.
But has no playbook to improve.
To actually run the race, you need that detailed forward-looking management information to plan the strategy, control the pace, and evaluate performance.
Both are essential for survival, but only the proprietary data system gives you that competitive edge.
Okay, so with that unique intelligence system in place, let's look at how the engine begins.
Let's do it.
If management accounting is the fuel, then the first thing we need is a destination. Part 2 is phase 1, planning.
This is all about recognizing opportunities, analyzing alternatives, and choosing the best path forward. And the sources divide this planning into two essential time horizons.
One long, one short.
We start at the strategic level, long-run planning. This answers the fundamental executive question. Where are we going over the next 3, 5, or maybe 10 years?
This starts with strategic planning itself, which is, the absolute most critical executive function. It's defining the vision, the markets you will compete in, your competitive positioning.
And crucially, deciding what you will do, but just as importantly, what you will not do.
Right. The example of Johnson & Johnson's deliberate decision to focus their entire corporate structure almost exclusively on healthcare is a powerful illustration of that strategic choice and restraint.
And once that strategic direction is defined, you have to fund it. That leads directly to capital budgeting.
So planning these long-term, high-stakes financial commitments.
Exactly. The investments required to execute that strategy. New machines, constructing buildings, funding massive R&D programs, or acquiring key talent.
Capital budgeting is inherently high risk, right? Because once that money is committed to a new factory, you can't easily get it back.
It's the definition of illiquidity and high consequence. Planning here requires management accounting tools to analyze future cash flows, calculate hurdle rates, and weigh the opportunity costs of competing investment options. Getting the capital budget wrong can sink the organization years down the line.
That sets the multi-year direction. But running a business isn't just about 5-year plans, it's about the daily grind. So how does the short-run operational planning take over?
That's where operational budgeting, or what some call profit planning, comes in. This is creating the detailed numerical plan, the budget, usually for the upcoming quarter or year.
So we're moving from the abstract strategy to measurable daily targets for every department.
Precisely. And the sources refer to the budget as the essential windshield for the business. That's such a descriptive image.
It really is.
A proper budget allows managers to foresee problems on paper. You don't wait for a cash crisis or a staffing shortage to hit you.
You predict it in your model 6 months out, and you correct for it during the planning phase. You avoid the surprise entirely.
Exactly. And within that short-run planning, managers are constantly juggling priorities, making decisions like whether to build a component internally or buy it from a vendor, or how to allocate labor across different projects to maximize ROI.
So planning gives you the detailed map and the estimated time of arrival.
Which naturally moves us to the active phase. Part 3 is phase 2, controlling. If planning is creating the map, controlling is the act of checking your GPS in real time to make sure you stay on the road.
And this is where the real-time data becomes vital. Controlling is not a year-end review.
No. It's the continuous, daily, even minute-by-minute use of data to monitor operations and steer the business back onto the course set in phase 1.
And the core mechanism that enables this real-time control is variance analysis.
A simple but incredibly powerful function of comparing the actual results achieved against the specific standards, the budgeted plan set in phase 1.
When we talk about standards, are we talking about more than just, spending too much money?
Oh, absolutely. We break down the variance to understand the root cause.
Yeah.
For example, if your labor cost was $10,000 higher than budgeted, a management accountant splits that into 2 questions.
Okay.
Did we pay too much per hour? That's a price variance. Or did the workers take too long for the job? That's a quantity or efficiency variance. Yeah. Isolating those reasons is essential for control.
I see. So if it was an unfavorable price variance, maybe procurement failed. If it was an unfavorable efficiency variance, maybe production is poorly managed. The ability to isolate the problem allows for a targeted correction.
That's the entire point. But since managers can't possibly watch every single metric, they have to filter the noise. They use a critical mechanism called management by exception.
So the accounting system only flags the areas that are significantly off track.
Exactly. You set a threshold, say costs deviating by more than 5 or 10%, and only those exceptions hit the manager's desk. This focuses attention exactly where it is needed most, its efficiency realized.
It sounds incredibly effective on paper, but I imagine getting an entire organization to adopt a system based purely on exceptions is harder than it sounds. How do you prevent managers from constantly overriding the system?
That's a behavioral challenge, not a technical one. The organizational culture has to trust the process and understand the purpose.
And the purpose is not punishment.
It's immediate course correction. We go back to that sports analogy. The baseball radar gun signals, when the pitcher's velocity drops, a deviation from the plan, allowing the coach to pull the pitcher immediately, preventing further damage. The whole point of the control phase is to correct deviations from the plan on an ongoing basis, minimizing losses before they compound.
Okay, so once you've steered the course and kept the ship afloat for the period, you reach the learning phase. Part 4 is phase 3, evaluating.
This is the final piece of the engine.
It uses data to look back, learn, and crucially, motivate future performance.
Evaluation closes the loop. It transforms management accounting from a real-time guidance system into a historical learning system, and this is what drives continuous improvement.
The sources highlight three functions here. The first is pretty straightforward. Analyzing results, determining where are we compared to the original plan.
The second is absolutely essential, providing constructive feedback. You have to communicate performance honestly and clearly to the teams, R&D, sales, production.
So they understand not just the final variance, but why it occurred.
Exactly. This feedback is what empowers future success.
And the third function is critical for organizational alignment and, human psychology.
Yeah.
Rewards performance. This is where the accounting system directly connects to incentive and compensation systems.
This is where management accounting solves the agency problem, that natural disconnect between individual goals and company goals. By carefully designing the evaluation and reward structure, the system itself incentivizes employees to act in the company's best financial interest.
If the metrics you are judged on lead to a bonus, you focus on those metrics.
Of course you do.
So if the control phase tells me what went wrong, like a variance, the evaluation phase tells me who did it and how to change behavior next time.
You've got it. And this evaluation step is so vital because it directly informs the next planning cycle. The cycle is continuous and iterative. Evaluate what you just did, challenge the assumptions you made, then shape the next plan based on those new insights.
Which leads to a new plan to control operations, which leads to the next evaluation.
It never stops improving.
That continuous cycle is the true competitive weapon. Part 5 is the competitive advantage. If management accounting data is proprietary, the process itself generates something even more valuable, organizational learning.
That's the higher level insight. The specific numbers can change, but the discipline of the PCE cycle creates superior, unique intelligence. Firstly, it ensures the organization gains a deeper understanding of the economics of our business than any competitor could hope to achieve. You know your true costs, your true efficiencies.
That deep understanding is worthless without action, though.
Which leads to focused action. It allows the company to massively increase the economic value they generate by focusing efforts where returns are highest and, avoiding investments in areas that historically underperform.
So you're allocating resources based on unique, proven facts, not industry averages or external reports.
And because the cycle is continuous plan, control, evaluate, adjust, it makes the organization adaptive and nimble. It doesn't take a year to course correct, it takes days or weeks.
The competitive advantage is the speed at which the organization learns and adapts compared to its rivals.
Yes. This constant internal optimization is the true source of proprietary advantage because the process itself becomes embedded in the culture, making it impossible to copy.
Let's connect these abstract phases back to the real world using those powerful examples from the material one last time. Think about how a university uses this cycle for its athletics program.
Okay, for planning, the university uses strategic data on recruiting trends and student enrollment to justify a new multi-million-dollar stadium that's capital budgeting.
They commit long-term funds to execute a competitive strategy for the football team over the next decade.
Right. Then for controlling, we return to the real-time application. That baseball team using the radar gun, the variance analysis, during the game to confirm if a starting pitcher is tiring and needs immediate replacement.
They are correcting a deviation from the operational plan right then and there.
And finally, evaluation. Analyzing last quarter's detailed sales data. This analysis leads to two things. Rewarding the top sales team based on their performance.
And simultaneously adjusting the assumptions for the next quarter's marketing budget, changing the plan based on what messaging and efforts actually worked.
The full loop.
Ultimately, this plan, control, evaluate cycle transforms a company's internal data into the means to outthink, out-execute, and ultimately crush its competition. It's an internal self-improving machine that runs on knowledge.
And we've established that management accounting uses this proprietary data, this detailed, often secret intelligence, as its weapon. But we need to emphasize that this data includes not just financial metrics, but increasingly vital non-financial metrics.
Like employee turnover rates, process cycle times, or detailed customer satisfaction scores.
Exactly.
This raises an important question for you to consider. If your competitive edge depends on superior insight and organizational learning, what specific, detailed, non-financial data is your business currently not measuring that? If integrated into the evaluation phase, could dramatically improve your result and challenge your assumptions in the very next planning phase. That's our deep dive for today. Keep learning.